Welcome to The Explainer. Today, we're stepping into the high-stakes, sugar-fueled, fiercely competitive world of the cookie kingdom. We're going to explore how the real world of business actually works behind the scenes. And to do it, we're looking at the biggest bakeries in the land, where literally millions of dollars and mountains of dough are on the line every single day. Now, you might look at massive companies and wonder, how on earth do they manage all that money without everything just falling apart? Well, the secret is in the rules. And to understand those rules, our cookie kingdom is the absolute perfect place to start. But before we check out those bakeries, I want you to imagine your favorite sports championship, okay? Now imagine if every single team just made up their own rules and kept score however they wanted. Like one team gets 5 points for a goal, another gets 50, and a third team just straight up stops counting when they're losing. It'd be complete and utter chaos, right? Well, business is exactly the same way. Without structure, it's just a giant free-for-all.
Section 1. Chaos in Cookie Kingdom.
Okay, let's dive right into this chaos. Imagine our fictional baking league, where bakeries are competing to be the absolute best, but they all keep score differently. Some are counting burnt cookies as profits, while others are completely hiding how much sugar they owe their suppliers. Now take a look at this massive number here. 1 million. Let's say that represents a single bakery's daily inventory of chocolate chips. I mean, these businesses are getting incredibly huge. When you're dealing with millions of ingredients, thousands of daily sales, and hundreds of bakers on staff, tracking things accurately isn't just a nice idea. If you mess up the math, the business literally will not survive. You just can't guess when you're dealing with 1 million chocolate chips.
To keep track of everything, we've got to understand the basic building blocks of business. In the cookie kingdom, giant industrial ovens, top secret recipes, and huge bags of flour are all considered assets. As the text defines it, an asset is an economic resource that's expected to be of benefit in the future. Basically, it's all the valuable stuff a bakery owns that will help them make money tomorrow and next year. It's their equipment, their cash, their ingredients. If it holds value and belongs to the bakery, it's an asset.
But it's not all sweet. We have to contrast those assets with liabilities. Looking at the definition, a liability represents debts or obligations owed by one entity to another entity, payable in money, goods, or services. Now, that sounds a bit complex, but simply put, an entity is just a business or a person. If our bakery owes the local sugar supplier for 500 bags of sugar, that debt is a liability. It's what they owe, and it drags their overall score down. In the real world, liabilities are the loans you take out or the bills you just haven't paid yet.
Section 2. GAAP. Rules of the game.
So with all these bakeries making up their own scoring rules and trying to hide their liabilities, how do we actually solve the chaos? We need a universal rulebook, which brings us to GAAP. That stands for Generally Accepted Accounting Principles. The formal definition describes these as the conventions, rules, and procedures necessary to define accepted accounting practice at a particular time. Think of this as the ultimate non-negotiable playbook. Every single bakery must follow these exact same principles if they want to stay in the league. GAAP outlines exactly when you can count a cookie as sold and exactly how you have to report your debts. It takes the guesswork out of the game so everyone is on a totally equal playing field.
And this brilliantly illustrates the whole idea. On the left, you have a sports rulebook. On the right, the GAAP playbook. They serve the exact same purpose. GAAP makes absolutely sure that everyone counts their assets and liabilities the exact same way. Without it, you could never fairly tell if Bakery A was actually making more money than Bakery B. Imagine trying to compare a basketball team playing by standard rules to a team playing on trampolines. You can't. GAAP ensures all businesses are playing on the exact same court under the exact same conditions.
Section 3. The Auditor, the Referee. But a rule book sitting on a dusty shelf doesn't do anyone any good if no one is actually watching the game. So who enforces this? Well, that brings us to the auditor. The text states an auditor is a person who audits financial accounts and records kept by others. In the cookie kingdom, think of the auditor as the completely unbiased, super sharp-eyed referee. They don't play for any specific bakery. Their only job is to protect the integrity of the game. They don't care who wins or loses. They just care that the score is real. Just like a referee blows the whistle on a travel or a foul on the basketball court, an auditor flags a business that isn't following GAAP. If a bakery tries to sneakily pretend a massive debt is actually an asset, the auditor runs in and throws the yellow flag. They keep the businesses honest. Like, if you try to tell the fans you sold 10,000 cookies, but you really just threw them in the trash, the auditor is the one who catches that foul. Section 4. Checking the scorecards. All right, time to see how this works. So how does our referee actually check the game tape? They look at the scorecards, officially called financial statements. The text calls this the presentation of financial data, including balance sheets and income statements. This is the ultimate record. The balance sheet is a snapshot of what they own right now, and the income statement tracks what they earned over time, like writing down every single cookie sold and every single bag of sugar bought. It's the documented proof of the game, play by play.
Let's move to the next part and see how this builds. There's a very clear 3-step process our referee takes here. Step 1, examine those financial statements. They really dig into the numbers. Step 2, check for conformity with GAAP, making sure that big rulebook we talked about was actually followed perfectly. And finally, Step 3, issue the auditor's report to declare the official results. It's a structured investigation to make sure the score matches reality. This entire 3-step process is what we call an audit. Looking at the official definition, it's a professional examination of a company's financial statement to determine that the statement has been presented fairly and prepared using GAAP. Notice those 2 words, presented fairly. The auditor is there to guarantee that the scorecard isn't just a work of fiction designed to make the bakery look better than it really is. They want to make absolute sure reality matches the paperwork. During this examination, an auditor breaks down a bakery's total worth into what looks like a giant financial donut. It's pretty cool. Notice the 3 slices here. We have a slice for assets, like our huge piles of chocolate chips, a slice for liabilities, like that looming sugar debt, and the remaining slice is equity, which is the baker's actual true ownership in the business. The auditor checks every single slice to ensure absolutely nothing is being hidden in the dough. If the liability slice is actually way bigger than the bakery claimed, the auditor is going to uncover it. Once they've checked every single slice, the referee makes their final official call, the auditor's report. It's defined as a written communication issued by an independent certified public accountant describing the character of his or her work and the degree of responsibility taken. Now, a CPA, or certified public accountant, is a highly trained professional who has passed rigorous exams to be allowed to make these calls. This report is basically a massive announcement to the fans and sponsors telling them, yes, this game was played fairly and you can trust the final score. Section 5. Why playing fair matters. Now, what's really interesting about this next part is why everyday people and investors care so much about this. It comes down to a really crucial concept, materiality. The glossary defines materiality as the magnitude of an omission or misstatements of accounting information that makes it probable that the judgment of a reasonable person relying on the information would change. Phew, okay, in plain terms, this is just how the auditor decides if a mistake is a massive game-changing deal or just a tiny typo. Not every mistake ruins the game, but material mistakes absolutely do. And this contrasts the difference perfectly. On the left, we've got an inconsequential misstatement. Let's say a baker dropped a single crumb, or maybe lost $1 in the couch cushions. No fan is going to stop cheering over a crumb. But on the right, a material misstatement. They're hiding a missing mountain of dough, or secretly holding $1 million debt. That is a material error. It would completely trick the fans and investors into thinking the bakery was winning when it was actually going bankrupt. If the error changes how you feel about the team, it's material. Because of those massive stakes, this powerful line is included in the official auditor's report. The auditor believes the audit provides a reasonable basis for his or her opinion. By saying reasonable basis, they aren't promising that they counted every single microscopic grain of sugar. I mean, that would be impossible. But they are acting like a sports commissioner, promising the fans, the banks, and the investors that they did a thorough check and you can trust the overall integrity of the game. So, what does this all mean for us? How do GAAP and auditing affect the apps you use, the clothes you buy, or the video games you play every single day? Think about it. Every single company that makes the stuff you love relies on investors and banks to survive. And those investors only hand over their money because they trust the referees and the rulebook. Without auditors and GAAP, the real-world cookie kingdom would literally collapse. Thanks for diving into this explainer with me, and keep questioning how the world around you really works.